Hello everyone. So the third part is activity ratio or turnover ratio. Inventory turnover ratio. Formula: cost of revenue from operations upon average inventory in times. Cost of revenue operation include revenue from operation minus gross profit, revenue from operation plus gross loss, opening inventory plus purchase plus carriages plus other direct charges plus closing inventory. Average inventory: opening inventory plus closing inventory upon 2. Average inventory days in a year or inventory turnover ratio. Average age of inventory is also called inventory including holding period. A higher the ratio indicates that higher inventory is selling quickly and better it is. From the following information related to company, calculate inventory turnover ratio. Opening inventory is given 20,000, closing inventory 22,000, purchase 80,000, wages 9,000, carries outward 2,000, return outward 1,000, revenue from operation 80,000, carries inward 4,000, rent 5,000. Solution: inventory turnover ratio, cost of revenue from operation upon average inventory. Cost of revenue from operation include opening inventory plus net purchase, purchase minus purchase, return outward plus wages plus carriages inward minus closing inventory. 20,000 plus 79,000 plus 9,000 plus 4,000 minus 22,000, that is your 90,000. Average inventory formula: opening inventory plus closing inventory upon 2. 20,000 plus 22,000 upon 2, that is your 21,000. Inventory turnover ratio: 90,000 upon 21,000, that is your 4.29 times. Note: carriage outward and rent will be ignored while calculating inventory turnover ratio. Trade receivable turnover ratio. Trade receivable formula, that is cost of revenue from operation minus average trade receivable in times. Trade receivable, it includes bill receivable plus debtors, opening trade receivable plus receivable upon 2. This ratio indicates the speed with which the amount is collected from trade receivable. The higher the ratio, the better it is. Average collection period days in a year upon trade receivable turnover ratio. Here is the question based on trade receivable turnover ratio. Calculate trade receivable turnover ratio and average collection period from the following information, particular as on 31st March 2020, assuming 365 days working in a year. Total gross revenue from operation is 11 lakh, cash revenue from operation 1,65,000, revenue from returns 11,000, provision for doubtful debts 1,910, total debtors 31st March 2019, that is your 55,000, total debtors on 31st March 2020, that is 66,000, bill receivable on 31st March 2019 11,000, bill receivable on 31st March 2020, that is your 22,000, trade payables on 31st March 2020, that is your 15,000. So trade receivable turnover ratio: net credit revenue from operation upon average debtors and BR. Net credit revenue from operation, that is your 11 lakh minus 1,65,000 minus 11,000, that is your 9,24,000. Average debtors and bill receivable: 55,000 plus 66,000 plus 11,000 plus 22,000 upon 2, that is your 77,000. Trade receivable turnover ratio: 9,24,000 upon 77,000, that is your 12 times. Average collection period days in a year upon trade receivable turnover ratio: 365 upon 12, that is your 30.42 days or 31 days. Trade payable turnover ratio formula: net credit purchase upon average trade payable in times. Trade payable include bills payable and creditor. Average payment period, that is your 365 days / trade payable turnover ratio. Here is the question based on trade payable turnover ratio. Credit purchase during the year, that is your 6,20,000. Purchase return out of the credit purchase, that is your 20,000. Opening creditor 1 lakh, closing creditor 1,40,000. Opening bills payable 25,000, closing bills payable 35,000. Here is the solution: trade receivable turnover ratio. Net credit purchase upon average credit plus Average bills payable. Net credit revenue from operation, that is your 6,20,000 minus 20,000, that is your 6 lakh. Average creditors and bills payable, 1 lakh plus 1,40,000 plus 25,000 plus 35,000, that is your 1,50,000. Formula for trade receivable turnover ratio, 6 lakh upon 1,50,000, that is your 4 times. Objective and significance, this ratio indicates the speed with which the amount is being paid to trade payables. The higher the ratio, the better it is, since it will be it that trade payables are being paid more quickly, which increases the credit worthiness of the firm. Average payment period, trade payables turnover ratio, it could be converted average payment period, which indicates the payment is normally taken by the firm to make payments to its trade payable. It calculated average collection period, 365 days in a year upon trade payables turnover ratio, 365 upon 4, that is your 91.25 days, or we can say 92 days. It stated earlier any fraction of a day would be practiced. It means that the payment will be made next day. Hence, in the above, 91.25 days would be implied to 92 days. Another, working capital turnover ratio. Formula, revenue from operation upon working capital. Working capital, it includes current asset minus current liability. This ratio reveals how effectively, efficiently working capital has been utilized in making revenue from operation. A higher ratio indicates efficient use of working capital. Here is the question based on working capital turnover ratio. Cash revenue from operation 1,30,000, credit revenue from operation 3,80,000, revenue from operation return 10,000, liquid asset 1,40,000, current liability 1,05,000, inventory is your 90,000. Here is the solution for working capital ratio. Working capital turnover ratio, revenue from operation upon working capital. Revenue from operation, cash revenue from operation plus credit revenue from operation minus revenue from operation return, that is 1,30,000 plus 3,80,000 minus 10,000, that is your 5 lakh. Working capital, current asset minus current liability. Current asset, liquid asset plus inventory, that is 1,40,000 plus 90,000, that is your 2,30,000. Here working capital, 2,30,000 minus 1,05,000, that is your 1,25,000. So working capital turnover ratio 5 lakh upon 1,25,000 is in 4 times. Thank you.